Hi everyone and welcome to this webinar. We're just going to pause for a couple of minutes and let a few more people join. I'm looking forward to sharing some information with you shortly. Thanks for joining us. Okay, hi everyone and welcome to this Fair4All Finance webinar on credit and loan products. I'm Kate Pender, I'm the Executive Director here at Fair4All Finance and I'm delighted to see so many of you who've joined us today. I just want to start with a couple of housekeeping matters. So we are going to record this session so that it's available for future use. And that means that you shouldn't have to take notes. We're also going to share the slides. So I hope that that's kind of useful reassurance that all of the detail that we're sharing today will be available to you in due course. We're going to use the Q&A function in the webinar, so please feel free to pop questions in there for us. We'll take them as we go, and there is time at the end for more questions. You're very welcome to share your questions anonymously, or by all means give us your name. Please don't share information that's confidential, because we are going to be publishing those questions in the chat, and we wouldn't want you to disclose something that you don't want us to share further. If for any reason you've got questions or queries that are confidential, we're really happy for you to come and talk with one of us offline. So I hope that makes sense. So to cover off our topics today, I'm really delighted to be joined by Tom Johnson from Trajectory, who's done the research that we're going to be talking about, and also my colleagues Vince and Cynthia, who are going to talk about some of the product work that we have happening at Fair4All Finance, specifically our work on the consolidation loans, trying to help lenders do more of those with a partial bad debt guarantee. And Cynthia's going to cover the work that we're doing in terms of benefit calculators, helping customers find what entitlement they have from additional income for the Department for Work and Pensions. So just to kind of bring us into the next slide to talk about what we're really here to cover today. What we're really wanting to go through is what the segments that we shared last month tell us about the decisions and the product usage in terms of credits and loan products that customers in each of these segments use. And I suppose there's a bit of so what about that as a purpose. But for many of us on this webinar, you know, debt products are something that we can really take for granted. And for many other people, that's not true. Lauren, who many of you will have met, who's our head of consumer insights, products and markets, really loves one of the quotes that Margaret Atwood, the author, shared. And that is that debt is like air. It's all around us, but we never think about it until something goes wrong. And it's really interesting just to consider how very different that experience can be for people in different segments, and to contrast that with some of our own experiences too. For people who are in vulnerable circumstances, credit can be a real lifeline when they need it most. And lots of the responsible lenders that we work with see that day in, day out. So today we're going to have a bit of a recap on what's in our financial segmentation of customers in vulnerable circumstances. And we're going to share some insights about credit and loan products that are used by people in those segments. And we're sharing this insight to really help you consider the products and services that you want to develop and offer, and with a view to helping you improve the financial resilience of the customers that you help, and hopefully to serve and retain them for the longer term. And really to kind of come to the nub of it, what's the point of all of this? What's the purpose? And on this slide, we've set out 4 of those really key things to focus on: building financial resilience, for loan providers, diversifying their portfolio to reduce risk, designing for that lifetime value that I just mentioned, and also thinking about how to partner up to do the product development work. I think it's fair to say that fundamentally, really good proposition design is really good business. And it's especially good business when it's driven out of customer need and out of really deep understanding of those customers. And lots of the insight that we'll share today will help inform how best to help the customers in the segments that we've identified. And I think it's really important to just maybe recap on one of the reflections that Sasha Romanovich, our chief executive, shared at one of the Bloomberg forums recently. And that is that across the financial services sector, the majority of products and services are designed for people with predictable lives and predictable incomes. And across all of the segments that we've looked at, there isn't that degree of predictability, and actually failing to design for the volatility in incomes and the vulnerability in circumstances means that there are real challenges for the people trying to engage with the financial services sector. So there's some really meaningful content here about how we can get the product and service offering better calibrated to the really challenging circumstances that people find themselves in. So just to move on to recap on the next few slides on the segments that we've covered. So last month we published our segmentation model, and what I'm going to do now is just really briefly recap on it. If you haven't already, I'd encourage you to download it. We've been delighted that more than 120 organisations have already done that, and many of them have said they've already started using it in practice, which is fantastic. Basically, that segmentation work uncovered that there are at least 17.5 million people in financially vulnerable circumstances. And we mean vulnerable circumstances in the broader sense. So not just those that are financially excluded, but those who are facing really challenging changes in their circumstances that have led to a different type of vulnerability overall. So in the next slide, I'm just going to recap on the kind of the structure of those segments across the spectrum of vulnerability and also across the age ranges. So in the segmentation work that we did, instead of focusing on demography, we looked at customer need and customer circumstances and product use. And this slide is just setting out the 6 segments that we developed across that age range on the vertical and in terms of vulnerability along the horizontal. I think it's really important just to share a little bit of what makes each of these segments different. So forgotten families and credit crisis families on the far right are those really in the most challenged circumstances overall. They're the hardest to serve, and they share stories with us that are really challenging to hear and really horrible to imagine what that might mean for them in their day-to-day lives. Across the rest of the segments, there's quite a blend of people at varying levels of precariousness and in quite different circumstances within each of the segments. And it's quite interesting from a provider perspective to think about the diversity within each of the segments and its implications in terms of the lifetime value for the customer. So for example, unsteady starters will include some households with relatively higher income who are at perhaps an early stage in their careers, and whose needs are going to change really significantly over time. So thinking about how providers can be offering the right product for them at the moment, but also setting out the right sequence of future products for them to step through is a really good and insightful way to start thinking about customer retention and that lifetime value of the customer construct. And the next slide, I'm just going to share a little bit of a high-level comparison of the segments that we worked up. And again, I'd invite you to spend a bit of time downloading the report that we published last month on these and delving into the detail that sits underneath each of them. But in terms of this comparison, what this does is set out the 6 segments in that first row, looking at the average age profile. We then look at the accommodation arrangements that those people are typically in, roughly what the household income is on average, and what the source of that income is, whether it's, for example, for unsteady starters, 0 hours contracts, some part-time work, a degree of income volatility, right through to those in the ungolden years, many of whom have very stable but very static incomes because they're primarily receiving pensions, and they don't have very much latitude to increase their income, and that means that they worry about that, particularly during this current cost of living crisis. So quite a big spectrum across the segments on those particular dimensions. And the last 2 rows are really looking at what their relationship is with credit and debt. So what products do they have, what sources do they get them from, and has their position in terms of debt changed significantly in the last 12 months? And again, as you kind of scan that, you can see that there are some really challenged words used in particular for segments 3 and 5, for the credit crisis families and for forgotten families. So just thinking about what that means in terms of the products and services that people are going to need is quite insightful. So I'm going to pass over to Tom now, just to talk us through what the research has actually unveiled, and then we'll come to some more detail on the products that we have been working on at Fair4All Finance. So Tom, over to you.
Thank you. Thank you very much, Kate, for that. Yeah, my job, as Kate said, is to take you through some of the findings of this research. And starting off on the next slide, just with an initial look at product ownership. What different products do these segments own? And one of the things you see immediately, looking across the different segments, is there's actually quite a wide variation in levels of product ownership. That's, I think, clearest when it comes to credit cards, which is the teal bar across those different 6 segments. We see the ungolden years, a segment named for David Bowie fans, has over 50% credit card ownership, but that then varies down to barely 1 in 3 of the unsteady starters and only around 1 in 4 of the credit crisis families. And there's a similar level of variation for each product. There are a few segments, for example, segment 3, the credit crisis families, which are significantly more likely to be using buy now, pay later products than other segments. Quite a lot of variation from segment to segment wherever we look. The other thing I think that's really worth pointing out when it comes to product ownership is this is an underserved population, and that is really clear in this data. For each of these different products, whether personal loans, credit cards, overdrafts, or BNPL, what we find is significantly lower levels of usage amongst the whole of this 17.5 million people in the financially vulnerable circumstances than we would see in the population as a whole. So, for example, according to Financial Lives data, around 16% of the population nationally has a loan of some sort. That's just 12% of this population. Credit cards, we would expect to see around 2/3 of the population have a credit card. Here, on average, it's around 42%. Overdrafts, around twice as likely the national population to the financially vulnerable population. What we also see with overdrafts is real differences in terms of uses from segment to segment. Credit crisis families really quite likely overall to say that they never or rarely get out of their overdraft. Difficult debts are also quite likely to be in that kind of circumstance. And finally, BNPL, around 1/3 of the population say they've used BNPL in the last couple of years, but only 14% of this financially vulnerable population. We do suspect there's some underreporting here. One of the findings which emerged really clearly in the qualitative research when it came to buy now, pay later products is that a lot of people don't see BNPL as a credit product. They see it as just another way of paying for something. So initially, just looking at product ownership gives us an idea of the variation and also, to some extent, the sort of lack of take-up of a lot of these products in the market. Going on to the next slide, though, we also see, I think, some really interesting differences in attitudes to borrowing. So the mindset that these different segments and people in the financially vulnerable circumstances are bringing to the market overall. There are some different attitudes to debt, to credit, and to borrowing. For most people, as you can see from the data on the left of the chart, paying back debt is a priority, but that is felt more strongly by some than by others, especially the ungolden years segment, where really quite a high majority would agree that paying back debt should always be a top priority. And that segment are also significantly less comfortable with borrowing generally. They're much less likely to say that it's okay to borrow money from family and friends, and they're not as likely to sort of feel a need to borrow money around particular events or times of the year at Christmas. Most other segments, though, tend to have a more nuanced, more balanced approach to borrowing, agreeing absolutely that paying back debt is a priority, but also being a lot more comfortable borrowing money from people they know, from family and friends. And especially in the case of the credit crisis families, one of the more vulnerable groups in all of this, particularly likely to acknowledge a need to borrow for particular events around Christmas here. One of the things that also really comes through and came through strongly in the qualitative research, and I think is evident to a greater or lesser extent in all of these segments, is that there are, in every group, some people who are very strongly resistant to borrowing. Indeed, can have quite strong negative reactions to pretty much anything that connotes or indicates borrowing, credit, or debt of any kind. And we found sort of repeatedly throughout the qualitative research in particular that can be a real barrier to engaging with products that ultimately could help them. Moving on to the next couple of slides and thinking in a bit more detail about loans in particular. And this next slide is one of the more complicated charts we'll show you. So I'll take a second just to run through it. What we've got here is for each of the segments, really the kind of stage that they've got to in terms of applying for a loan. So the sort of orange blocks at the bottom of each segment bars are the proportion of people who've thought about it but haven't really done anything further, haven't looked into it. They've potentially acknowledged a need for a loan or an interest in getting a loan, but haven't gone very much further than that. The kind of teal bar just above that are people who've done some research but not got on to the application stage. And then the final two bars at the top of each of the segments are people who have applied and have either been successful or unsuccessful. And then the line that goes from left to right across there are basically the proportion of people who haven't even thought about taking out a loan at all. And starting with that, just consideration varies a lot across the segments. You can see that, for example, the ungolden years, the majority of this segment haven't even thought about taking out a loan. It's not really on their radar. But the majority, particularly of the first three segments, are all in this kind of mindset already. They are all thinking about taking out a loan. And actually around 1 in 4 of each of those segments have made it into an application process. But making it from consideration to application is by no means guaranteed. Actually, quite a lot of people drop out at that kind of consideration and research stage, especially the unsteady starters. There's really no guarantee that people will acknowledge the need for a loan, look for it, and then once they're looking and reviewing their options, will go on to make an application. A significant amount of unsteady starters, so yeah, around 1 in 5, 20% of our unsteady starters drop out at this point. That could be a result of their needs changing, but I think it's also like to be a result of them not finding the right product or just simply not thinking they're going to be successful. So therefore, what's the point in making an application? There are also really wide variations in success rates too, perhaps not surprisingly, given what we know about their circumstances. Credit crisis families and forgotten families are the two segments most likely, in fact, more likely than not, to be declined when they apply. Also worth pointing out that unsteady starters, well, just about have a success rate for an application for a loan that's over 50%. It's pretty much 50-50. So quite a significant dropout, not just in terms of going from consideration to application stage, but also for when people are applying, rejection rate to be quite high. And a final point on this one as well, I'm just picking up on unsteady starters and squeezed and sliding. Some of the qualitative research that's been done with these segments has also really indicated a very clear desire for clarity and transparency around products, really wanting to understand hidden fees and costs at a very early stage. Looking at the next slide and moving on to understanding what the key reasons different segments have for considering or applying for a loan in the first place. And we saw previously quite a wide variation in applications, quite a wide variation in success rates. There's actually here, as you can see, quite a lot of consistency in the reasons that these different segments are considering loans in the first place. On this slide, we're not showing the ungolden years segment because their application, they're very unlikely to be in the sort of marketplace for a loan at all. But for all of the other 5 segments, the number one reason why they're looking for a loan or considering a loan is the same. For all of them, it is a reaction to an unexpected expense. You know, it could be the boiler's exploded, the roof's fallen in, the car's broken down, whatever it might be. It's going to be a need that is reactive and often quite urgent in nature. That's probably going to be reducing consideration time. It means that speed is likely to be a primary concern. There are other reasons as well that are quite high up the tree. So paying off or consolidating debts is quite a common reason across the segments for looking at loans, particularly for the most vulnerable segments, so the credit crisis families and forgotten families in particular. These are the segments who are likely to have multiple sources of debt and often likely to have sources of debt that are not necessarily from previous loans, but from bills that are in arrears, that kind of thing. Forgotten families, it's worth pointing out as well, are the only ones. You can see the sort of dark blue box towards the sort of right of this table, the only segment who listed covering everyday expenses as a reason for a loan. Worth pointing out that the research that underpins this table was done in the spring, as we've seen the cost of living and more recently changes to housing costs really start to affect more people. It's possible that might be a more prominent reason for other segments too, as we sort of head into 2023. Just looking through some other aspects of this table. So loans for planned expenses are also quite common, especially for those segments, particularly thinking about squeezed and sliding and difficult debts here, that have slightly higher incomes overall. In the qualitative research, we often heard that those loans were for various things, often funding trips, holidays, new cars, that kind of thing. And finally, loans for smoothing incomes are also quite a common driver for all 5 of these segments, but especially for that first and youngest segment, unsteady starters, who are the most likely to be working 0 hours gig economy jobs and potentially have a kind of higher demand there. So a fair bit of variation in applications in terms of the reasons for applications for loans. But if we move on to the next slide, here you can see that we go from some variation to virtually no variation at all. Quite a lot of uniformity in terms of what people in these segments think are the important features of the loan itself. Universally, the most and convenience, getting the money as quickly as possible in the fewest possible steps. I think it speaks a sort of an echo to that previous slide where we saw that unexpected expenses were the primary reason for applying for or considering a loan across all the segments. Very much speaks to that. For many people, there may not be much time to weigh up options. For a lot of the segments, in fact, all but one of the segments, the reputation of the provider comes next, as the next most important factor after speed. For those with bank accounts, people that we spoke to in the qualitative research, not everyone had a bank account, but for those that did, often that went hand in hand. In the qualitative research, we heard people would typically just sort of pop into the branch that they use most often. I think there was a sense for those customers that there was already a bit of a relationship. Maybe they were a bit of a known quantity, maybe slightly higher levels of trust in those interactions. Then comes price and comes cost, and usually in that order. So people thinking, first of all, about the price of the loan in terms of interest, and then about the cost in terms of the repayment amounts. That was a pretty consistent finding in the quantitative research. But in the qual, we did sometimes hear different things, where actually the cost repayment amounts were more important. And in the quote that's pulled out of the Hall test that was done in Glasgow last year, we heard this exactly. This was a Rangers fan actually who took a loan out for a trip to Seville to watch the Europa League final and possibly regretted that decision given the result. He was really kind of the complete opposite to what we heard in the quantitative results. For him, it was all about the repayment amounts. He said he didn't really notice the interest rate at all. He certainly couldn't tell us what it was. Finally, on this slide, just worth mentioning, I think, the role that recommendations play. For most people, it's price comparison sites that are really important, and possibly a reason that reputation and price in terms of the interest of the loan rate so highly in the factors overall. So going on just to the next slide, and just thinking, I think briefly, sort of just pausing to reflect on some of that data and thinking about what all of this might mean. I mean, first of all, I think it's really important to overcome attitudes to credit. We encountered this frequently in the qualitative research tool. A lot of people are pretty negative, are starting off on the back foot when it comes to anything that sort of signals kind of credit or borrowing or debt at all. And so whatever can be done to start to build trust, whether that's including external review ratings, testimonials, can be, I think, really, really positive. Also, I think given the relatively high rates of rejections and declines, particularly amongst certain segments, credit crisis families and forgotten families in particular, considering the messaging around that can be really important as well. That might mean integrated benefit calculators. It might mean more tailored guidance around the reason for the decline and helping the borrower or the potential borrower take steps to improve their chances to access credit in future. And finally, there is a need for speed with this. Across the segments that are most likely to be applying for loans, speed and convenience are just pretty much always the biggest feature in their choice of product. And this won't be new news to you, but I think it is just to underline how important that is. Moving on, and a little bit more data, this time looking at sources of information, where people are going, where people are getting more information when they are starting to consider or think about getting a loan. And the first thing to say is that most people, when they are in this position, do look for more information. They do look to talk to friends or family, people they know, or look for more information from another source, typically online. But a significant minority don't talk to anyone. And that is particularly the case for our two most vulnerable groups, credit crisis families. 18% say they don't talk to anyone, and 16% of forgotten families are in a similar position. In the qualitative work, again, we found a little bit more about why this might be. I think it links back in many cases to the dislike of loans and sort of feeling on the back foot in those relationships, maybe being a bit embarrassed or reluctant to talk about it with people that they know, often not knowing where to turn to for help, and also a real lack of trust. And that lack of trust, I think, extends to the young golden years segment as well, who are kind of proudly independent and sort of very, very happy not to talk to other to get more information from people. The quote on the top right of this slide from a depth interview with somebody in the Forgotten Families group is, I think, a really interesting one, as it tells us a bit about these attitudes. The woman we were speaking to was sort of initially telling us quite a lot about how she absolutely didn't trust anyone in financial services at all. And then a few minutes later, was sort of ruefully sort of thinking about, well, you know, actually, it is a concern. I worry that there could be things out there that we're missing out on, but I just don't know. I don't know who to speak to. She certainly wouldn't trust anyone beyond her immediate family for any kind of financial advice. Now, happily, most segments are much more likely to look for information, especially online. Younger segments in particular are most likely to talk to people that they know, I think suggesting potentially a really strong role still for word of mouth, while difficult debts, are particularly likely to talk to the provider directly. That's a segment with quite a lot of financial services experience, so potentially a bit more comfort talking to financial services providers directly. In the online quantitative research, which is what this data is based on, we found less of a role for face-to-face information seeking and use of services like citizens advice or local council services. But the qualitative research, in particular the Hall test, which included a large number of people who were digitally excluded, those sources played a much bigger role, so suggesting there is still a role for that kind of advice. Just moving on to the next slide, and again, just pausing, I guess, just to reflect on what some of these things might mean. So first of all, thinking about the customer journey. I mean, just fundamentally, I think the segments are a really useful way to think about each stage of that customer journey, from their first steps on the ladder in terms of acquisition and application, right the way through to sort of managing them through the results of that application, and then delivering sort of customer experience. Price comparison sites are a really good source of customer acquisition, but obviously important to know exactly what is required to do this well. That could include risk scorecards and the technical capability that might be required. Potentially a really strong role, as we've seen, for anything that leverages kind of word of mouth and people's informal networks and relationships. So potentially refer a friend schemes could be quite a useful way and a good source of new business, particularly if you have a product or an offer that is working for a particular segment or a particular type of person, and you think you might be able to sort of roll that out more widely. And finally, if possible, including user surveys, optional user surveys on website, which can capture more information about the reasons that people might be exiting a journey early, and obviously finding out more from that side of things. A final few slides from me, and just moving on and talking a little bit more about credit cards, which I think are a really interesting aspect of this, because they're such a widely held product in particular. Now, first of all, this is basically another version of that slightly more complicated chart that we showed earlier on around loans, looking at credit card applications and success rates. And immediately, I think there's a clear difference between that chart and this chart, in that there's just many more people in the marketplace for credit cards. It's a much more popular product, more people are sort of considering it and more people looking at it. The majority of the first 4 segments have looked into a credit card application over the past couple of years, and actually has a higher chance of applications and higher levels of success rates than loans as well. In many cases, the same kind of trends emerge though. So unsteady starters are the most likely to consider, but also the most likely to drop out at the consideration stage as well, just as they were with loans. Overall, success rates are significantly higher. In every segment, applications are more likely to be successful than unsuccessful, but also success rates are lowest amongst the groups that we might expect them to be lowest amongst, so the credit crisis families and the forgotten families. Still more likely to be accepted than rejected, but lower levels of acceptance compared to some of the other groups. The young golden years are the least likely to have considered applications, but actually they're also the most likely to currently own a credit card as well. So that might simply be a function of just not having as much need. They might already be being well served on that front. Moving on to the next slide, and just thinking about some of the important features for the credit card. You might remember for the loans, there's quite a lot of uniformity, a few patterns emerging here. Not really much in the way of patterns here. Something of a patchwork created by this table. Key features for credit cards really quite different from segment to segment. Different hierarchy for each of these segments. Most segments prioritize provider reputation above all else, but there's a couple of exceptions there. Squeezed and sliding segment and the difficult debts segments are more likely to be looking for 0% introductory offers rather than the reputation of the provider. That's going to be top of their particular trees. That might simply reflect those segments which have slightly higher incomes, a bit more experience of interacting with financial services. It might reflect a bit more confidence with the market. The other thing I think that really jumps through here, and is a bit of a pattern, is the role of recommendations, especially from price comparison sites, particularly prominent for unsteady starters, squeezed and sliding, and forgotten families. For unsteady starters and credit crisis families, recommendations from people they know are quite important as well. Worth also highlighting the importance of balance transfers as well, particularly prominent for credit crisis families and difficult debts. Those are 2 segments with higher levels of debt, so possibly not too surprising there. And the final thing just to pull out here is, well, there's the quote on the top right here is from a young woman that we met in the unsteady starters group at a Hall test that we did in Middlesbrough. I think it reveals a lot. It's a really useful quote tells us a lot about sort of noble, often very good motivations for getting a credit card around sort of building credit scores, but actually it can have the complete opposite effect if circumstances change or if safeguards aren't in place. A final slide of data from me, just looking at this one in terms of the number of credit cards owned and some repayment behaviours too. So worth pointing out, of course, that credit cards are the most widely owned credit or loan product that we looked at here. But there are still some big differences between the segments. Around 1 in 4 of our ungolden years segment own more than one credit card, but only around 1 in 8 of the forgotten families own more than one. So real differences across the segments in terms of sort of detail of what they own. It's also, I think, really some real difference in terms of use, in terms of the cards that people own as well. Mainstream providers, the kind of market leaders in terms of Lloyds, Barclaycard, Halifax, are pretty common across all the segments, but for a couple of the segments, particular credit crisis families really over-index with Capital One, with Vanquis, with Aqua, suggesting that they are the organisations that are best meeting their needs. And also, finally, there are really major differences in terms of repayment behaviour too. Half of the ungolden years segment say they repay the full balance each month, but for every other segment, that is not likely to be the most common behaviour. And actually, for a number of the segments, never repaying the full balance is something that is pretty prominent in terms of the mix. Final slide from me, just reflecting on what this might mean. So fundamentally, credit cards have really wide appeal, potentially a really good area of product development for those that don't offer cards at the moment. Credit builder cards could be a really attractive option, could work really well for some segments, and obviously fitting in with one of the themes that was introduced right at the start of this presentation, really potentially central to building long-term financial resilience. However, as I think was exhibited by that quote from the Hall test in Middlesbrough, really important to have the right protections in place, support on how to improve credit scores and prevent situations worsening, and clear messaging on repayments needed as well. For those that are offering credit cards, clear messaging on just the impact of different types, different amounts over time is really important. And for some borrowers who are going to be consistently struggling to repay more than the minimum, helping proactively to shift people onto a different product or even a consolidation loan could be a really good option. And with that, I'm going to hand back to Kate.
Thanks so much, Tom. That was really comprehensive. I just want to touch on a few of the projects that we're already running at Fair4All Finance. Many of you will be aware of the product testing that we have underway for the no interest loan scheme, which we're really excited by. And we ran in parallel to that procurement an ask of lenders to come forward and to suggest other innovative products that they wanted to test with us. So we've got some of those coming underway at the moment, including working with a credit union on a revolving credit product, and also a loan product for self-employed people. So some interesting alternative products already kind of in our sights. But I think the two things I really wanted to focus on this morning are really kind of front and centre in terms of the products that we think are really relevant during the cost of living crisis. And the first of those are consolidation loans, which, as you saw in Tom's slide, are a reason for all of the segments, excluding the ungolden years, to consider applying for a loan. And we think that consolidation lending is really uniquely relevant during this cost of living crisis. So I'm going to hand over shortly to my colleague Vince to talk you through what we're doing about that. I think it's also really important to recognise a little bit to the sentiments that Tom shared in terms of the research, that some people are really sceptical about taking on debt, and for others it's just not a possibility. So we're really also focused on trying to connect people with the alternatives that are most relevant to them. And that's why it's really important to us that so many of the responsible lenders that we work with have such great relationships to support providers who can help people find alternatives to debt, be that debt advice itself or referrals to charities or grant providers. And as part of that work, my colleague Cynthia is going to talk about what we're doing to increase the number of people who are completing benefit calculators and grant checkers to see what else they're entitled to. And some of those statistics are pretty compelling. £15 billion of unclaimed benefits every year, total postcode lottery about what grants are available. And we've been delighted to kind of bring some of the benefit providers together with the grant checker providers to get a much more joined up customer journey to help people get alternatives to debt products when they need them most. So Cynthia's going to cover that next, but before we go there, let me hand over to Vince to talk about consolidation loans.
Thanks, Kate, and good afternoon, everyone. Thanks for sticking with us so far. So just a couple of slides from me on consolidation loans. The first bit that we'll look at is a little bit about the why. That there's clearly far more detail than I'm able to share in the next few minutes, but I think we already know that the cost of living is making people's existing debts harder to pay, whether that's because that interest is rising or there's downward pressure from lots of their other living costs going up as well. But we know that's genuinely out there. We've seen from the research that either paying back a debt or consolidating a debt, and there's probably an element of overlap there, sits across everybody that we've researched to some degree or other. And we're also hearing from lenders that they're seeing more active inquiries around people looking at being able to consolidate their debts into something that's, you know, repackaged and more affordable. I think we've seen evidence when it's done well, it can be transformative, both in terms of the support they get from the lender in achieving what they need to do, but also the financial impact it has on them in clearing out more affordable monthly income, and also helping their mental resilience. Juggling many payments can be really stressful for people. Repackaging it and getting it into a single, known, fixed, budgetable payment does massively lift a lot of weight off people's shoulders. We know that across the spectrum of customers, everyone can benefit. We've pulled out 3 segments, but I think with the different lenses that different lenders have, I'm sure there are touch points across all of our segments that we've talked about today. So what have we looked at? We've looked at how we could support lenders step through into lending a little bit more and supporting more people. Obviously, one of our purposes is to expand affordable credit to people, but also going back to some of the initial points about building financial resilience, also considering lender diversification on their portfolio and long-term value as well. So they said that we would like to reach more customers, but actually a little bit of support around guaranteeing some additional risk and the debt that might generate would be really helpful. We think we can do it successfully, but you know, we're putting our own money on the table, and you know, there's a reticence to be able to really take that full step. So hopefully what we're putting in place allows some lenders to be able to do that. So in doing that, we've set aside £3.5 million for a partial bad debt guarantee to help, so that we can work with a few lenders to really explore consolidation lending into those new areas. Loads more detail available through the link. Have a look on there. There'll be more information than I'm able to transmit in the next few minutes. So have a read, follow up with me. The details are on there. We've set a closing date of the 18th of November. That's not a hard stop closing date. We're just trying to keep the momentum moving forward. But if that date, if it's of interest to you and that date is a little bit tight for you, then again, reach out to us and let's collaborate. Let's keep the dialogue open. So if we could move on to the next slide, please, that'd be really great. So just quickly, a little bit about customers. So who do we want to reach? So I think we've got the most dullest titles available of population A, population B and population C. But if you think about population A and B, A's are probably really closely aligned, or marginally outside of lenders' existing appetite to lend, and we would like to see about 80% of our support reaching those people. So we believe they'll be affordable. We think there'll be marginally more risk to write the debt, and therefore we're able to, you know, step in and help that. I think the second population B, are probably at the, you know, much deeper in challenging circumstances, probably likely to generate more risk and more debt, and that's why we think probably about 20% of our support and those customers need to be at those groups. What we're essentially looking at in what we're proposing is having a little bit of diversification across the portfolio. So in the round, it's profitable, but accepting some sections of the customer groups might be a little bit more challenging than others. And then those two groups are both supported by the guarantee, but we do have a third aspect to what we're offering as well, and that's potentially some marketing support. So there are groups of customers who are, you know, prime customers to lend to, profitable, probably looking for greater value, maybe moving, you know, looking for alternatives to some more of the mainstream lenders. And we'd like to see, you know, lenders being able to support more of those because they should be good business. So using our segmentation, using some marketing support, you know, we're happy to work with lenders on that basis as well. So very quickly, a little bit about the support. We've got £3.5 million as a partial bad debt guarantee available. Yeah, looking forward to lenders expressing an interest in participating in that. Based on that, we've obviously had to play around with assumptions, but we believe around about 9,000 loans could be supported by that guarantee using the figures that we've used. But ultimately, you know, quantums are unknown, the volume of people are unknown, and the debt call on it is unknown. So, you know, we believe that there's a good slice of people who we could definitely support, and lots of learning to be had out of that. The lenders that participate, the one thing that we are asking of them is that they carry the debt level that they've got on their broader portfolio. So really, our guarantee steps in on the incremental loss that they may suffer on these loans compared to their standard loans. The other thing we'll do is we'll lend in waves. I think that's something we're keen to explore. Is, you know, let's in the nicest sense tread carefully. So let's apportion some of the money. Let's lend initially. Let's measure that. Let's go again. Let's learn. Let's iterate. So what we don't have is, you know, the fund ultimately being exhausted really quickly if some of the lenses aren't quite right on what we're doing. And then the last piece before I'll hand on is we're interested, because we believe these loans in the round should be incremental but also profitable, is how we can work with lenders to share a little bit of that profit back to the fund so that we can ultimately keep that fund running for longer to benefit more people in the long run. So like I said, very quickly cantering through what we've got on consolidation loans, lots more available online. Reach out if you want to have a follow-up and with more questions in a little bit more detail. Absolutely perfect. And what I'll just leave you with, seed of thought before I hand across to Senthon, is how, when you look at some of these aspects of support, if you're also able to combine it with things like benefit calculators, how potentially for the right customers that is transformative in many respects. So appreciate that was quite a quick whiz through, but conscious of time, so happy to hand on to Senthon. Thank you.
Thank you, Vince. So for a lot of people out there, it's clear all they need is extra money to be able to cope with the climate that has always been tenuous and continues to deteriorate. So as Kate mentioned, so when we know there are approximately 15 billion worth of benefits and tens of millions more in social tariffs, discretionary council relief and hardship grants that go unclaimed each year or available to those who apply, we need to do something about it. So put another way, 8 million households are missing out on extra funds, And the most commonly cited reasons are firstly awareness, so not knowing the existence of a benefit, and secondly, feeling that they won't be entitled to it. So it's not for someone like me, or I won't qualify. If I was to relate this back to our segments, for credit crisis and forgotten families who receive the most amount of benefits and are most reliant on them, there's likely to be a greater impact. For forgotten families, it's likely to be universal credit that they're missing out on. However, our less excluded and more precarious segments, such as squeezed and sliding and unsteady starters, could also be missing out on benefits, and they're most likely to assume that they're not entitled. And lastly, we know that pension credit is really underutilized, with 2 billion going unclaimed, which would most likely impact our on golden ears segment. So what are we doing about it? At Fair4All, we're supporting benefit calculators, Invest and Policy and Practice, and GrandFinder Lightning Reach to integrate into customer journeys where people in vulnerable circumstances are likely to interact. Our key hypothesis is that by making it super simple to show entitlement, we'll be able to encourage people to claim benefits. And I think we want to move beyond a link on a website and have these checks integrated into key customer journeys. To that effect, we've been working with providers to develop their technology and help them work with lenders, credit reference agencies, price comparison websites, and other support services. Whether it's in their lending journey while folks are waiting on a loan decision, or as an alternative to a decline, arrears management within the members areas, basically any process where we can show a customer a quick check of their benefits using existing information and then take them onto a fuller journey showing entitlement is what we're trying to achieve. So I'm going to finish off with a stat from Invest and what they're seeing with one of their partners who they've integrated in their calculator into the lending journey. 69% of the people who go on to complete the full benefit check are seeing an uplift of an extra £450 per month, and that equates to more than 5,000 per year. These are significant amounts and something that we just can't ignore. So anyone on this call who wants to work with us, please get in touch and we'll be happy to work through the solution with you. And thank you, and I'll pass it back on to Kate.
Thanks, Cynthia. That was really insightful and some really powerful statistics there. I just wanted to share a little bit of an overview about the rest of the work that's underway in our research portfolio. There's some really interesting things that we'll be able to share with you over the coming months. So we've currently got some work underway looking at the experience of Black, Asian and minority ethnic communities in terms of financial inclusion. And we're looking to really fill sort of gaps in understanding about how inequality is currently experienced in financial services. We've also got some research that's happening at the present time. I find the updates horrifying every time I hear them, because it's basically focusing on the experience of illegal money lending, and really unfortunately the kind of collapse in the supply side of high cost credit has led more and more people into illegal money lending, which we and many others are really alarmed by. So more research coming on that in due course. We've also been working with 6 credit unions operating across Merseyside to evidence the hugely positive impact that they're making in that area. And across all our work, we've commissioned lots of lived experience research, and we've got both a digital panel operating where we're getting fascinating insight from people about how they manage their money, some really sophisticated budgeters amongst those in really vulnerable circumstances with a lot of tech savvy in terms of using every app under the sun to track every last pound and pence. So it's been quite an interesting research project just in terms of busting some of the stereotypes about people in vulnerable circumstances not being good at managing their money. Some of the people we've been doing that research with would put many of us on this webinar to shame in terms of how they're managing their pennies. We're also doing regional workshops in terms of that lived experience and a wider kind of longer term customer panel, which is really exciting. We're shortly going to publish some work on best practice during COVID-19 in terms of the support that the banks offered. Some really amazing things were done during COVID, which we think potentially have great relevance now for the cost of living crisis. So, for example, UK finance statistics suggest that 27 million people benefited from an interest-free overdraft during COVID. Another million people benefited from deferred payments on either credit card or loans. So some really amazing decisions about flexibility, obviously supported by the FCA's instructions on the same. So we'll be publishing some of that shortly. There's also quite a lot of work underway in terms of looking at the deduction lending landscape, and in particular how products that are linked to either salary or benefit deduction-based lending are working and what the borrower's experiences of those products. So we'll be publishing some of those insights soon. And that has a bearing too in terms of some of what we've talked about today in terms of product relevance and how best it's sorted out. So I'm going to stop talking now and just open the floor and see if anyone's got any questions that they want to share with us. I don't think we've had any come through in the chat that we've not yet responded to, so we can certainly do that. In terms of the question about where you can find the benefits calculator, we can publish those links with the slides. Cynthia mentioned a number of the providers that we're working with there, so there isn't a single answer. But we are also really keen to work with people who want to use those calculators in whatever customer journey they're offering. So we'll publish email addresses for Cynthia if you want to talk to him about that, for Vince if you want to talk with him about consolidation lending, and for the rest of the team if there are other pieces of research that you're interested in hearing about in due course. But yeah, I will pause there and see if anyone has any additional questions to share. I'm not sure whether that means that no one's got any questions or you're all really desperate to get off this webinar and have a sandwich and a break, which I think is also entirely understandable. So let me bring this to a close and to say thank you again for joining us. It's been great seeing so many of you on the call. Thank you especially to Tom and to Vince and to Cynthia for sharing all of their insight. And behind the scenes, you haven't seen them, but James and Tamar and our team make these webinars possible, and I'm really grateful for all of their efforts on the same. So thanks everyone. We'll share more of that research in due course and hope to see you on more webinars like this in due course. Thank you. Bye.